One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only podcast giving you that knowledge, giving you that investment banking knowledge related to the technicals and the non-technical aspects. Man, I'm so grateful that you're here. We're going through every question that I can possibly find about investment banking because I want you to be prepared for your interviews and, more importantly, be prepared for your profession, right? Whether you're a career changer like myself or you're already in the finance world and you're just trying to sharpen your skills, that's why I'm here. So thank you for joining me. My name is Alex Mason and I'm your host. And today we're talking about how a company actually buys another company. There's different currencies that a company can use when they're making an acquisition. It's not just like going to the grocery store and saying, I want to buy some avocados and I have $10 in my pocket. That's the only way that I can buy these avocados, especially if, say, you're in a place that doesn't take credit cards. You know what I'm saying? It's not like that when one company buys another. There's different forms of currency, different ways to finance a transaction. So that brings us to today's question and today's topic. What would a company pay for another company? How should that happen? Should they use cash? Should they use stock? Or should they use debt for an acquisition? Which one should it choose? And let's assume, for the sake of this discussion, that a company has a lot of resources and they have availability of each of these three options, which is definitely not always the case. But let's assume for this discussion that it is. Now, this is an interesting question to me because I think the answer is nuanced and it depends a lot on the situation. For example, if interest rates are really low, then raising debt might make sense, right? It might make sense for a company to go to a lender, go to a big bank and say, hey, bank, can you lend me some money? I'll pay you some interest because I want to go buy this company. And the bank will happily say, yes, here you go, pay me some interest. So that may make sense if rates are very low. Now, if the acquiring company's stock is trading at a premium, let's say it's trading very high, then selling stock might make sense because that's easier for the company to do. They can hold on to their cash. They don't have to raise debt that they have to pay back and pay interest on. They can just sell some stock because shareholders are clamoring for it because they see that the company has a bright future in their perception. So therefore, they're bidding the price of the stock up very high. So that might make sense. And then if there's a downturn in the economy, let's say there's a recession, and all of a sudden everyone's concerned about liquidity and valuations get compressed, guess what? Cash really comes in handy. Nothing like cash in a recession or even a depression when you can have a deflationary environment potentially. Like that's how Warren Buffett at Berkshire Hathaway scooped up so many stocks and so many companies over the years. Is he waited for these downturns and he showed up with a pile of cash and said, hey, I'm going to make an acquisition with cash. And he got really good prices and really good terms for his acquisitions and his deal making. So you have these different currencies, cash, stock, and debt, and they all have their advantages and disadvantages. But let's kind of step back and kind of put a bow on this with a general rule of thumb, okay? So in general, cash is going to be the cheapest and least risky option out of these three currencies. And let's talk about why. Well, if a company has cash, they're earning interest on that cash. So there's going to be a loss of that interest, that foregone interest, if they use cash for an acquisition. So that's kind of the con. But that foregone interest will usually be cheaper than the interest payment on debt that they raise. It's kind of like how you go to a bank and you put money in a savings account and yeah, you're making a few percent on interest, with the bank as a depositor. But if you were to go to that same bank and borrow money from them, are they going to charge you a lower interest rate than the interest rate they're giving you? No, they're going to charge you a higher interest rate because they're trying to make a spread on that. And that's the entire business model of banks, right? Or at least part of the business model. So yeah, the foregone interest in cash is usually going to be lower than the interest that's going to be paid on debt. So that makes it a cheaper option typically than debt for a company to use their own cash. And then also, cash is more favorable than stock a lot of times because stock prices fluctuate. They're always changing in the market. A company may be valued high one day, low another day, and a lot of value could potentially be lost once the deal is announced, because when the deal is announced, people in the market are going to look at that and say, oh, well, this company's worth way more than we think it was before yesterday. Or they may say, you know what, this company is worth way less than we think it is. And if they see that stock is going to be used in a transaction, the market will often reflect that because they're going to adjust for the shares outstanding increasing. So your earnings per share is going to go down, or your implied earnings per share is going to go down. And if the valuation multiple holds, let's say that a company is trading at a 12 times price to earnings ratio and the earnings per share all of a sudden plummets, well, in order for that 12 times PE to hold, then the stock price is going to suddenly go down too. So you have these effects in the market based on expectations. And so stock prices can fluctuate. That's really the short answer there. But cash does not fluctuate, right? Like in the short term anyway. So there's that. And also another comparison here between these three, debt is usually cheaper than stock due to what we've discussed in the past with the accounting related episodes, the tax deductibility of interest, right? And also the fact that equity typically trades at a premium relative to whatever the risk-free rate of the debt is. And just remember that cost of equity formula. So you have these different dynamics. So generally, cash is the cheapest and least risky option. Debt is probably next, and then stock is probably last. However, if a company has a very high stock valuation, then that might be a good option for them too. So that's what I got for you today here on Investment Banking Insights, and I'm so grateful that you're listening to the show. This is Alex Mason. I am your host, and I hope you have a wonderful, incredible day. Take care.